This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Okay, the board. Page 17. The Board of Directors. A director is defined in English company law. I don't know what it's defined as here, but in English company law, a director is defined as being anybody who occupies the position of director, which is a really helpful definition. A director is anyone who occupies the position of director. It actually does continue and says, anybody who occupies the position of director by whatever name called. Doesn't matter if they're called the human resource manager. If they occupy the position of a director, then they are a director. And shadow directors are anyone in accordance with whose instructions the directors are accustomed to act. So this would normally be the directors' wives. Anyone in accordance with whose instructions the directors are accustomed to act. Men tend to operate in accordance with the instructions from their wives. Combined doesn't. That was me being facetious. Don't put that in the exam. Combined code establishes roles and responsibilities, provide leadership, represent the entity in its dealings and to the public generally. Directors set the agenda for board meetings and decide matters which are to be determined by the board and therefore not capable of being delegated. They have to be determined by the board rather than by any delegated subcommittee. They decide on strategy, and it's the directors who select the chief executive. If the 10 of us here in the room now, if the 10 of us have been appointed to the position of directors of VIA Finance, we've been appointed by the shareholders, officially. We've been appointed by the shareholders. But one of us needs to be appointed to be chief executive. And it's not the shareholders who choose the chief executive. It is we 10 in the room who will say, does anyone want to be chief executive? But it's actually probably more the pushy one. It's probably more the one who says, we need a chief executive and I'm going to put my name forward. Does anyone object? Because if you do object, you and I are going to have an argument. So it's the pushy one. It's the charismatic one. It's the over self-confident one who pushes themselves forward to be chief executive. Probably. In practice, probably. So we need to decide, need to select a chief executive, but we also need to select a person who will be the chair. And these, under corporate governance principles, these have to be two separate people who occupy these two major top positions in the company. The chief executive is one person, the chair is another. If you go downstairs and have a look in the Balsam's lecture room, there's a picture like this one here of Vistus. There's a picture on the wall. I've forgotten what he's called. Gouldis, I think. And Gouldis was the chair, and he's an alumnus of the business school. And he's underneath it says chair and chief executive of Balsam's company between the years 2003-2008. And it's wrong. It's wrong. It's a public company. And public companies should have two separate people at the top. People of equal strength, equal character, equal power, equal charisma, so that no one individual is capable of dominating proceedings. There's always somebody there to balance that power. Not only the chair to balance the chief executive, but if 5 of you were executive directors, then we need 5 non-executive directors, so that no one group can dominate the proceedings of the combined board. So not only should there be a balance at the top, but there should be a balance within the board itself. And there should, according to corporate governance principles, there should be at least as many non-executives as there are executives. So you've got 5 executives, then there should be at least 5 non-executives, and possibly 6 or 7 non-executives. Who's going to pay for these people? Yeah, the customers, you and me. Because they're not going to do this work for nothing. This is an additional expense which is introduced by the CABA report and the corporate governance principles. It's an additional expense for public companies. Someone is going to have to pay for the time that these non-executives... Admittedly, it's only an immaterial amount, typically, for a big company, public company. The cost of the non-executive directors is only going to be a tiny bit. So we need 2 people, 1 chief and 1 chair. You've got to call them chair as well. I can't call them chairman, because that would be sexist. That would be genderist. So they're not allowed to be called chairman. They now must be called chair. We've gone very politically correct in the UK. So we're not allowed to call people chairman because it may be a woman. And chairwoman doesn't have the same ring about it. So we just call them chair. Madam Chair and Mr. Chair. The same as we're not allowed to call Manchester United Manchester United. We have to call them Person Chester United. Desexualise the name. Directors' roles and responsibilities continued. Establish corporate culture. The corporate culture. Leading by example. When I appear at work wearing a suit, I expect you to appear wearing suits as well. Don't expect you to turn up in jeans and sweaters, and I expect you to be, because I'm establishing the culture, the minimum acceptable level of dress code. So tomorrow I expect to see suits. So seriously establishing corporate culture, a culture of honesty, openness, probity, culture of integrity and independence, culture of competence and decision making, culture of fairness and transparency, building the reputation of the company and accepting responsibilities, accepting that we are accountable, culture, leading by example. Ensure that those charged with taking operating decisions are doing their job properly. Who are the people taking the operating decisions? And this second-tier management. It's not the executive board, it's the people to whom authority has been delegated. It's the human resource manager, the purchasing manager, whereas the board of directors determining the strategy, the operational decisions are being taken by the departmental heads. Establish and implement an effective system of internal controls capable of risk assessment and management. Risk is a big issue in P1. It is a big issue. The name of the paper, I told you this morning, the name is going to be changed to Governance, Risk and Ethics. It's a big issue. I will be astonished if the word risk does not appear in your exam. I would almost be tempted to leap off the 26th floor of the Radisson if the word risk does not appear in your exam. Capable of risk assessment and risk management. Ensure that aims and objectives of the company are realistic and achievable. If you establish an aim and objective which is not realistic or not achievable, what's the natural human reaction? If I say to Yanis, for instance, Yanis, I want you to do this audit, and I want you to do it in 3 days. And last year it took 3 weeks. I want you to do it in 3 days. What's the natural reaction of somebody who's given an unrealistic and unachievable objective? Yeah, I can't do it, therefore I won't even try. Yeah, I can't do it. There's no way I can achieve this. I'll not even try. It's just a human reaction. So ensure that the aims and objectives are capable of being achieved, and then we have a target, then we have focus, then we have governance, which is a system by which, corporate governance is a system by which companies are corporate governance, by definition, is a system by which companies are directed and controlled. System by which companies are directed and controlled to ensure that they are realistic and achievable. Ensure that all employees are aware of the company's responsibilities to its stakeholders. Past exam question, this. How as an auditor, do you ensure that all the company's employees are aware of the company's policy of its responsibility to its stakeholders? How would you, as an auditor, Carlis, how would you, as an auditor, confirm that all the company's employees were involved in ensuring what the company's policy or applying the company's policy to its stakeholders? How would you do it? How would you confirm that all employees are involved? Nothing, Carl, come on, it's common sense. How would you do it? Ilse, how would you do it?
I will discuss this with the employees.
Ask. Yeah, ask. Do you know what the company's policy is with reference to its relationships with stakeholders? Yes, Mike, I do. Good, that's another one. Are you aware of it? Yeah, all employees are aware. And what practical steps can a company take to ensure that all its employees are aware of the company policy? What practical steps can a company take to make sure that all employees are aware of the company's policy? Posters. Yeah, posters in the workplace. When I was at financial training, we used to have all sorts of motivational posters, like a picture of a lion, and underneath it said, "In our business, the customer is king," and a picture of a lot of hens. And they were called, this was a story about 4 hens. One was called Somebody, one was called Nobody, one was called Anybody, and one was called Everybody. And somebody said it was not their responsibility, it was everybody's responsibility. Everybody said it's nobody's responsibility, and nobody said... And it's motivational posters to motivate the workforce into accepting and helping to pull in the right direction that the company wants to go in. So we establish the strategy, the tactics are determined by the second level management, but the operation is left then to the employees. We're all pulling together. We're all singing from the same songbook. We're all pulling in the right direction, all pulling together. And that will promote the success of the company. We need to hold regular and frequent board meetings. Yeah, I put regular and frequent. It's all right just putting in the exam, they need to hold regular board meetings, but if every 4 years is regular, every 4 years, on the anniversary, every 4 years is regular, but that's no good. They've got to be regular and frequent. And again, it comes in past exam questions. The frequent, I would say, probably no more than a 2-month gap between board meetings. There was one question where the board met irregularly, on average every 3 months, and the suggested solution says it's not frequent enough. So regular and frequent board meetings. We need to assess our own performance. Now there's a thing. We need to assess our own performance. Well, I think I've done quite well today. I'll give myself a bonus. The board is responsible for assessing, measuring its own performance, and reporting annually to shareholders about the performance. Who's going to assess our own performance? We 10 directors, 5 execs and 5 non-execs. Who's going to assess the performance of we 10 directors? We must. So if I think, for instance, Agnes has done very well, I'll probably only think that on the basis that she thinks I've done well as well. So you scratch my back and I'll scratch your back. Oh, no, it's not quite so simple. The non-executive directors will be primarily involved in the various subcommittees required by corporate governance. And one of these subcommittees is the Remuneration Committee. And one of the tasks of the Remuneration Committee is to assess the company's performance, but also to assess the individual directors, executive directors' performance. So these non-executives, who maybe meet every 2 months, will discuss how well the company is doing. As a board generally, as an executive board generally, but also they're going to assess the individual contributions of you and you. And the success of the company has maybe improved its position by, say, 10%, but if it had not been for you, they could have improved by 12%. So you're actually holding the company back, and therefore your performance is not acceptable, and therefore your remuneration will reflect this less than ideal level of performance. It would only have been 8% had it not been for the efforts of you, and therefore you should get an additional. So this non-executive subcommittee, the Remuneration Committee, has got to assess the performance of the company as a whole, the board, the executive board as a group, and then individually, then we need to assess the individual director's performance. Directors should submit themselves for re-election. It says every 3 years, and I've read recently the figure 2 years instead, and I still think it's 3. I can't remember where I read it. But they should submit themselves for re-election every 3 years, if they want to stand for re-election. And for listed companies, there are some additional requirements, and we get these additional requirements on page 19. Listed companies should appoint appropriate and independent non-executives. They should establish subcommittees. I'll give you 4 there. There are others. So there's the Audit Subcommittee, which I'm going to suggest is the big one. We may possibly do without any of these others. Possibly. But the Audit Committee is really important. So this is a major one. And we'll be looking again in close detail about the role of the Audit Committee and the advantages of an Audit Committee. The Remuneration Committee I've just mentioned. The Risk Committee, remember I keep saying that risk is growing in importance in the ACCA's mind and is therefore going to be an integral element of the new title of the paper, Governance, Ethics and Risk. And they're changing the name of the paper. Just listen, they're changing the name of the paper better to reflect the content of the paper, and that is as a result of feedback from the major contributors to discussions. The profession itself, the audit profession, and the directors' organisations say risk is more important. We need risk, and so they're going to switch the emphasis of the paper more towards risk than it already is. The Nominations Committee, Nominations and Succession Committee. Another one would be the Ethics Committee. You could put another subcommittee in there, the Ethics Committee. And another one, the Corporate Social Responsibility Committee, or the Environmental Committee. All these subcommittees, which are almost peripheral, almost on the edge of the company's activities. The company is formed to provide a service or manufacture goods. That's the focus for the executive board. On the fringes, we should have all these committees, all these subcommittees, making sure that in the pursuit of our main objective of manufacturing cars, nevertheless we are acting in an ethical, corporate, social responsible way. Higgs identified 4 factors. Who's Higgs? Well, he was one of these people that wrote a report and which is now into the combined code. He's identified 4 factors which affect the effectiveness of the board. The time available, personal competence, 4 factors affecting the effectiveness of the board. If you've got incompetent directors, how can the board be effective? The quality of information which is given to the board members, and the boardroom culture itself. If it's a boardroom culture where at the board meeting out will come the alcohol and the cigars and pornographic films. If it's a boardroom culture which is less than professional, then you can't expect the board to act effectively. Time available. Within English case law, it was established that you can only expect directors, not the chief executive, but just ordinary directors, you can only expect them to devote such time as is reasonably necessary for them to perform their duties, or as is described and prescribed within their service contract. Personal competence, you cannot expect any greater degree of competence than may reasonably be expected from a person of that age, experience and qualification. So it's up to you to find the people of the right age, experience and qualification. Quality of information. There was a past exam question that said more information leads to better decisions. It's not a P1 question. More information leads to better decisions. Discuss. Well, discuss.
Was the more information gives?
The more information I give to the directors, the better will be the decisions of the directors.
In case if information is correct?
But I'm assuming the information is correct. Otherwise, that has to be a basic assumption. If I give them misleading information, then clearly it can't lead to better decisions. Can you see an argument against that comment? More information leads to better decisions. Discuss.
This information must be material.
Yeah, and therefore, if I give them more and then more and then more and then more, eventually some of the information I'm giving them is immaterial, and therefore it's not going to affect the decisions. Another one? You can swamp them with information. I mean, you've got your course notes here. These course notes could have been written in the form of a book on each chapter. And if I'd given you 15 books, therefore, would that have led to a better chances of passing the exam? Or is it going to be just overwhelming and it's just too much information? I think you can have too much information. Another comment I would make is that the statement more information leads to better decisions automatically presumes that we're not already making optimal decisions. If I'm already making the best decisions, what's the value of more information if I'm already there? And as a further point, more information leads to better decisions. It doesn't. It doesn't. Surely the decisions are made by the directors, and the quality of the decision is dependent upon the competence of the directors. So it doesn't matter if you've got an idiot on the board, it doesn't matter how much information you give, it's still an idiot's decision. Now the exam answer, and I've forgotten which exam it wasn't this nor its equivalent, and it was a number of years ago. The exam answer said this is quite clearly, obviously true, that the more information you present, then the better the decisions you will get. And I disagreed strongly with that conclusion because of the four situations we just identified, that more information does not necessarily. I mean, you can accept it as a basic principle, but there are certain arguments against it. And boardroom culture, we're back into honesty. What's another word? What's another word for honesty? It's what a dentist does when he gets that sharp instrument and he goes in your teeth and he starts pricking away at your teeth. What's that instrument called? Do you know? It's called a probe. All right? And he probes into your guts and your teeth, into the holes in your teeth. And probity is the word you're looking for. Honesty or probity. What's next in the mnemonic? Accountability. And then comes responsibility. And then comes, I'm not asking you because you get it every time, what's the D? What's the D? She knows. She knows because every time we've come through this, it's been her. Decision making. Then the R. Think of John. Yeah, reputation. Then the I. Integrity. F. And T. And how are you going to subdivide stakeholders? Yeah, B. The first one, the prime one, the prime, yeah, primary. Number one is primary. That's what primary means. It means number one. The primary and secondary. I. Internal, external. N. Narrow and wide. K. Known and unknown. L. No, legal. Oh, almost actually, from the same word. Legitimate. A. Active, passive. V. Voluntary, involuntary. R. Recognised and unrecognised. Okay. Other major points addressed by Higgs were the role of NEDs and performance measurement for the board as a whole and for individual directors. I've actually just mentioned that, haven't I? Performance measurement for the board as a whole, but then also the individual directors. The combined code breaks down neatly into 4 subheadings: directors, their remuneration, accounts and audit, and investor relations. And here we've got directors. Page 21 then. Every listed entity should have an effective board. Every company should have an effective board. Every firm should have an effective board of partners. The people who lead any organisation should be effective. Because if they're not effective, what happens? The company underachieves, and in its underachievement, it faces excessive competition against which it loses. It underachieves in terms of money generation, improvement of TSR. What's TSR? You wrote it down. TSR. The company's objective is to improve TSR. Who? Say, I think you said it right. Yeah, total shareholder return. So they failed to achieve a sensible total shareholder return. Every company, every organisation needs somebody who is effective, or a board of people who are effective. The positions of chair and CEO should be held by individuals. This comes up, I'm going to suggest, I may be wrong, but I seem to remember it's come up in every exam so far. The position of chair and CEO should be held by different individuals. And you're asked to comment on how does the company satisfy the principles of corporate governance. And one of the first things you say is because the chair and the CEO should be separate people. Boards should comprise both exec and non-exec. That's another thing. That the board in these exam questions tends to be made up of 3 or 4 executive and maybe 1 non-executive, and you say there should be at least 3 or should be at least 4 non-executives. And another thing he does is he says the non-executives are a long-term friend of the family and a person who has been an occasional consultant in the last 5 years, and they're not independent. So there's another point to put in. The appointment, there should be at least as many NEDs as execs. At least as many NEDs as execs. The appointment to the board should be formal and transparent. It should be the formality of the exercise. The reality is that it will be the directors who identify somebody who they wish to serve as a non-executive, and they will appoint this person. But that appointed non-executive director must themselves then retire at the next general meeting and seek re-election by the shareholders. So the reality is the directors will appoint. The reality is that the shareholders will simply approve that appointment. And I have never heard of a director who was not approved by the shareholders. As much as anything else, think about it, the directors themselves are likely to hold reasonable number of shares. They're recommending that to discuss and if thought fit to reappoint somebody as a non-executive. The directors themselves are likely to vote on that resolution in favour of the resolution. The institutional investors with the big shareholding, they will have been consulted, and therefore it's difficult for them now to say, no, we don't want the person as a non-exec. They will have been consulted because of the regular and frequent meetings that the executive board should have with their institutional investors. So they're going to vote in favour, and then here's me with my 14 shares saying, no, I don't think they should be reappointed. They will. The reality is that the shareholders will approve the director's appointment. Information should be provided to the board. Information should be provided to the board. It should not, therefore, be restricted to individual members of the board. It should be provided to the board of directors. And remember, we had a point earlier that said there should be detail of matters to be agreed by the board, not by any subcommittee or any individual on the board. Matters to be agreed by the board of directors. They are so important. There should be a formal assessment of the board's performance annually. Well, we've already mentioned that a couple of times as well. And they should submit themselves to re-election on a regular basis, with intervals not greater than 3 years. So that's also been mentioned. Page 22, directors' remuneration and accountability. Sufficient to attract, retain and motivate. If you ever see a set of public company accounts, look for the Remuneration Committee report and you will find the expression attract, retain and motivate. Proportion should be performance related. It's good. It's good that directors should be rewarded as a result of their performance, but it should only be a proportion, and the performance related element should not be a substantial part of their remuneration. It should be part of their remuneration, but it shouldn't be the major element. And ideally, performance-related remuneration will comprise remuneration which they can collect or to which they become entitled on the basis of a long-term strategy. Short-termism is not good. No director should be involved in determining their own remuneration. This Remuneration Committee, these non-executive directors, one member of the committee will probably be the chief executive. So an executive member will be within the Remuneration Committee. But the rest of them will be non-execs. And the non-execs are the ones who determine the exec's remuneration. Except the chief executive, because he can't be seen to be involved in determining his own remuneration. But who determines the remuneration of the non-execs? Who determines these 5 remuneration? If these 5 determine yours, who's going to determine theirs? The executive. Yeah, but only on discussion, only after discussion. You'll be the chief executive in discussion, probably with the chair, in order to determine the non-exec's remuneration. Shouldn't be remuneration, it should be fees. Remuneration Committee should publish a report of their activities. If you ever look at a set of public company financial statements, certainly from the UK, there will be a Remuneration Committee report. Accountability and audit. This is the 3rd subdivision of the combined code. The board should present a balanced assessment of the company's position. A balanced assessment, not a biased assessment, a balanced assessment. As independently and objectively as they are able. Given that they are not independent and not necessarily therefore objective, but nevertheless a balanced assessment of the company's financial position. They should maintain a sound system of internal control. One of their responsibilities, they're accountable for maintaining a system of control and a system whereby auditors get involved in order to safeguard shareholder investments. Formal arrangements should be in place for considering how to apply financial reporting and internal control procedures. Formal arrangements company's procedures, formal arrangements in place, company manuals. This is how we do it. Should be formalised. We should make arrangements for maintaining an appropriate relationship with the auditors. There's interesting. An appropriate relationship with the auditors. Regular and frequent communication with the auditors. And this will involve establishing an audit committee. This is one of the reasons. If it's the only reason, it's still a big one. This is the reason for having an audit committee. And audit committees could very well come up in the exam, because audit committees does come up in the exam.